TCS has announced 23rd February as the record date for its 18,000 crore buyback. This is a tender buyback, one in which TCS will buy back 4 crore shares at a price of 4,500 rupees per share. Now, this buyback comes at a very interesting time for investors. At a time when Indian IT companies or shares have been under pressure due to a global technology meltdown, the question is, does this buyback offer investors an attractive opportunity to tender in at a high price of 4,500 rupees? Now, here we're not giving you an answer, but we just want to lay out a few points that investors should consider before tendering or participating in this buyback. Now, 15% of the buyback is reserved for retail shareholders holding less than 2 lakh in value. Now, that is anyone holding approximately 50 shares. That is, assuming the record date, the share price of TCS is above 4,000 rupees. In all the 3 previous buybacks by TCS, the one in 2017, 18 and 2020, most small shareholders did not participate, which is why the retail shareholding acceptance ratio was 100%. Now, if that is the case this time, we have an acceptance ratio of 100%, which means if an investor buys 50 shares at a price of 3,700, 3,750 thereabout and tenders in at the price of 4,500 rupees, then the investor stands to make a 20% return in a span of few months. But as the acceptance ratio declines, so will the return from 20%. For instance, at a 40% acceptance ratio, the return can be just 8 to 10%. So the benefits of participating in a buyback are immediate cash return and a return of 10%, 20%. Now, IT stocks have declined with the global technology meltdown. TCS's forward valuations have come down from 32 times forward multiple to now 29 times. And if there is a further decline in stock prices as globally interest rates start to rise and valuations get reset even further, does it make sense to lock in profits at 4,500 rupees per share and then come in and buy at lower levels? But the downside of buying shares with the intent to participate in the buyback is that what if everyone decides to tender? Everyone thinks this 4,500 is attractive at a time when technology names under pressure. Then the acceptance ratio declines, which will further bring down the return an investor makes. Also, investors who tender their shares in the buyback will get the cash benefit now, but they stand to lose the long-term benefits in terms of dividend as well as capital return. Remember, TCS has spoken about a multi-year technology upgrade cycle. For institutional investors, the acceptance ratio has varied from single digits in the past to as high as 40%, as per research from IFL Alternate. Will institutional investors tender more this time given the weakness in technology sectors, or will they not risk going underweight in a large technology name? That remains to be seen.